Hello and welcome to this week's episode of Nucleus Investment Insights. The question for discussion today is, has the Australian housing market peaked? On the agenda, we'll look at the current state of the market and explore the reasons for and against why the property market may have peaked. And of course, we'll also cover the investment applications at the end. My name's Sam Kerr and I'm the Senior Financial Advisor at Nucleus Wealth. Today, as always, we have Damien Klassen, the Chief Investment Officer. Damien, welcome. Thanks for joining us.
Thanks, Sam.
Awesome. Also, we have Leith van Onselen, the Chief Economist at Nucleus Wealth. Leith, thanks for coming along today as well.
G'day, Sam. Hello, everyone.
And also on the show, we have Professor Steve King. He's an economist and author of Debunking Economics and is currently running for the Senate for the TNL, formerly the New Liberals. Steve, thanks for joining us.
Thank you. It's a lot of the invitation, guys. Let's have some fun here.
Excellent. So, Steve, I understand you're streaming from Amsterdam and it's rather late in the evening over there. So, yeah, we appreciate you making the time to come on the show.
Oh, you can thank me and jet lag for that.
Excellent. Well, I'm sure it's going to be a really informative discussion with so many great minds. Just a quick reminder before we get started. If you enjoy our content, please subscribe to our YouTube channel and click the bell below to be informed when we go live or have a new episode recorded. Alternatively, follow us on your preferred podcast platform. Our show's available on all the majors. And for those of you listening live, feel free to drop your questions in the YouTube live stream chat, and we'll do our best to answer them during the show. So now we've got that little bit of housekeeping out of the way, we'll get into it. So Damien, I'll hand it over to you to get us started.
Yeah, sure. So, we've been speaking a lot about houses over the recent time, and we thought it was well worth getting Steve back on. And I guess the part of it is we saw the interest rates rise in the US for the first time last night, and prospect of potentially Australian interest rates rising as well. I mean, we certainly had the 3-year rate. They took off the term funding facility, which was providing cheap fixed term loans for people in Australia, and so with the prospect of those rising, I thought it was well worth getting Steve back on and his thoughts. I guess what I wanted to start with, given the idea that debt is pretty key in terms of this whole in terms of house prices rising, is I guess, Steve, how far do you think interest rates could realistically rise before we start creating I guess problems for Australian economy and potentially recession?
Well, I reckon if they get to 1%, they'll be lucky. And the reason is that there's an enormous level of private debt. Now, I've seen my the usual suspect like Steve Kuklaf saying that, don't worry about the debt. Look at the asset prices, and that's brilliant because that's exactly the same arguments that are being used in America before the crash in 2007. Don't worry about the level of household debt in America. Look how much the house prices are worth. Well, that worked out pretty well, and the reason is that. It's not just assets versus liabilities, it's servicing the cash flow. And unless you're going to start selling the kids as an output of the house, your servicing is going to be covered out of your own income. And with an increase in interest rates, that means the financial burden on households rises very dramatically. And the idea that households who are currently carrying a debt level of 1.2 times GDP in the aggregate can cope with a rise of 2.5%, as I've heard. In the market forecast, I think is ludicrous.
And so this is, I mean, I guess this comes back a little bit to this idea that that central banks have sort of moved on from being managers of the economy in terms of trying to get smooth out the sort of fluctuations, and sort of moved more into trying to keep these asset prices at levels that you sort of got. We're in this part where it's. If asset prices are high, then people will spend more money, and therefore we need to keep asset prices high so people spend more money. I guess there's a question for me about, especially we're looking at investment markets all the time, and as to at what level you think markets might start to panic, because that's it's almost as if we need to wait. And we saw a couple of Christmases ago that happened in the US. they started raising rates. Markets all panicked and fell 20%, and then they changed their mind and went back. And I guess it's that the power put, so to speak, and whether that exists in Australia as well. I guess your thoughts around that.
Well, it's certainly turning up in Australia as well. And when that was first proposed by Ben Bernanke back in 2009, I call it a pact with the devil. Okay, because this is using quantitative easing to try to keep asset prices high, and you literally find Bernanke saying in that 2009 document that they were trying to exploit the wealth effect, because as people have more money in their bank in their share portfolios, they'll therefore feel wealthier and they'll spend more money. Now, shortly before Bernanke made that comment, there was a research paper published by this organisation, I think called the Federal Reserve, showing that there was no wealth.
Right. I feel like the Australian market did a similar one. And Leith, you might.
Yeah, vaguely I remember it was sort of just pre-GFC, I think. There was a RBA paper like that, and I think Lucy Ellis, who's I think an assistant governor or something there, made the famous statement where she said that all the financial engineering that's happened is a good thing, and basically that all the debt's been held, in the areas where it's least worrying, etc., etc. And she ended up eating a obviously had pie and face. So there was certainly a lot of that sort of thinking back then. But at least with Australia, the thinking seems to have changed since then. Have you lost Steve?
Yeah, Steve's dropped off. Yeah, you ruined my segue. That was a very neat segue to use to you, Leith, but you ruined it by pointing out that Steve's I think he was having a bit of. I'm hoping he'll drop back on because but let's I guess Leith, do you want to talk a little bit around that? So we spoke about the interest rate rises and we've got 2.5% sort of priced in at the moment. I think was that right in terms of
it was So basically, the financial markets last week, their latest forecast were for the overnight cash rate. The official cash rate from the RBA to rise from 0.1% to 2.25% by June 2023. So that's a very, very quick rise, and it's also they effectively plotted a whole bunch of countries against each other, and Australia's was going to be the fastest rate rise out of all of them, and the second biggest behind the RBNZ. So basically, that's the equivalent of 9 interest rate rises, effectively by June next year. Now, by my calculations, if you use the RBA's standard variable mortgage rate of 3.45%, that's the average standard variable mortgage. Discount variable mortgage rate, and you apply that sort of rate increase, you're looking at a 29% increase in monthly mortgage repayments. If that was to happen.
Sorry about that.
No worries.
Look, I've got to tell the audience what happened there. As well as having a gammy knee from an operation which went bad in the airport yesterday, and finding we don't have internet back in my flat in Amsterdam, we're trying to sell, so I'm trying to use the mobile phone. My battery has failed on the computer, but I thought it's okay. I can use the computer as an iPhone stand, and then I got your iPhone has overheated. I had to put it in the bloody fridge to cool it down.
You should have bought an Android, mate.
Oh, mate, honestly. So it's now going to be shaky cam. Okay, I'll hold it in my hand and hope it doesn't do the same thing.
Excellent.
I just cannot believe that this is just ridiculous.
Yes.
Anyway.
Okay, well, so I was just that's right. We segued into Leith just talking a little bit about market pricing and how we're looking at nine rate rises.
Yep.
I guess one of the things I did want to raise, though, we've obviously had a lot of supply chain issues, and I think we certainly started with the view that look, we were going to go through this sort of supply chain super cycle where everyone had needed to restock, and you got a lot more onshoring and all these types of things, and then we saw the next phases of of Omicron sort of cause more issues, and we've seen issues in Russia, and plus we've got I guess costs in terms of the travel costs. I guess what I'm wondering is to what extent might it be that supply chain's having a bit of its own Minsky moment in terms of everything was stable and so you just kept on getting shorter and shorter and shorter, and then we've reached a point of breaking, and so the pandemic sort of broke it. But then we've actually had another bunch of issues sort of overlaid over the top of it, and whether that's going to sort of turn into a a bigger issue for that supply
Yeah.
chain.
I think that's very real, and this is I mean, the reason we've had such low, one of the reasons for such low inflation since the days of Vogler is the relocation of production first of all, other third world countries, then China. And of course, the other third world countries, particularly, they started off with actually places like Malaysia and Indonesia being the first places to open free trade zones. This is right back in the 1970s. But as soon as the wages rose, they'd move to another country. And the reason that didn't happen with China was twofold. And I was actually at the laying of the concrete in Shenzhen Free Trade Zone in 1981. Okay.
Right.
By sheer coincidence, I didn't say I got there deliberately, but I took a tour of Australian journalists there in 1980-81 over winter to have conference with Chinese journalists. So we happened to go there, and we actually went before before the first business had started, and it was the best meeting we had in the whole of China, the most intelligent management. And they explained they were going to use a loophole in the American trade laws to enable re-export without paying tariffs. And they included a deal that any company that established business there had to have a Chinese partner, and the Chinese partner had to own 50% of the business within 5 years. Now, that's how they created an industrial class over there, a capitalist class, but it's also how they made sure they got the American technology and it didn't go away again. So that's a huge difference in how China approached it, just places like Indonesia and Malaysia. And then what it meant is over time, we have a supply chain. Like the iPhone that's just overheated on me has pieces from 120 countries, okay? Something of that order. Well, that works so well. So long as everything's perfect, everything's perfect. As soon as something goes wrong and a little virus comes along, bang, the supply chain is very fragile. And we're now finding we've done the opposite of the Nassim Taleb anti-fragility. We've got a fragile system which is not at all robust, and hit it with a series of shocks, and the whole supply chain breaks down. And this is not going to change. In fact, we're walking into a universe of pain from the climate, and we're not going to restore what was normal or made normal between 81 and 2018.
And do you think this is? I mean, some have suggested that there's going to be a lot more localization and you'll see more automation and things like that. But that seems like a 5-year plan rather than a 5-month plan to solve this problem.
It is. You haven't got the time to respond to it. I mean, the automation, 3D printing, where that works. Onshoring, I think, is going to be the theme for investment for the next decade or two, because this is not the last time we're going to break that supply chain. So that you will be seeing the need to onshore production once more, and that's actually an investment opportunity, which is a change, but it's actually a positive. But you're not going to get rid of the cost pressures in any particular alacrity, and that is going to affect us very, very badly for certainly most of the next decade.
And so the question then is, I guess, if we've got if that's sort of, I think I'm more and more in the case that we're extending it out, and so we're going to be looking at. I think I still classify this inflation as in some way transitory, but it's certainly over a number of years rather than a number of months. And so, if you're looking at central banks starting to raise rates and we do start seeing economies starting to tip into recessions, or certainly unemployment starting to spike higher, but supply chain problems not being fixed because we're just in this phase of structural change, and so you're sort of looking at higher inflation and higher unemployment, with the view that there is an end to the inflation, but it's the question is, will central banks sort of turn around and go, well, you know what, we're just going to have to smash inflation, regardless of how high unemployment gets? Or do you think there'll be a couple of years of them saying, well, we'll ease off because we'll raise interest rates to the point where it becomes a problem for employment, but beyond that, we won't actually push higher to try and get inflation down to sort of back below 2%?
Well, I think there's going to be also the fiscal side of things, because before the supply chain hassles, the most recent ones hit, people one thing which we regularly commented on was how high household savings were, and B, how fast we came out of this recession. Now, the answer to both those is the level of government spending, because that's literally creates money in the hands of and this went, rather than going to the finance sector, which is what QE does, this was stuff going to Main Street. And of course, Main Street suddenly had an increase in their savings accounts, because that was the mirror image of the increase in the level of government debt. And that gave you a huge stimulus. So when you see unemployment rising because of, say, if the central bank puts up interest rates to try to control inflation, and because this is a sort of inflation that it can't control using interest rate, it's not a demand inflation, it's a supply inflation, then that could cause unemployment from the collapse in credit. And when the collapse in credit hits, the governments will dive back in there again, because, oh my God, we might lose election again. Watch out, there's this candidate called QAnon who might beat us. And you will get the fiscal authorities throwing back in again. But I think I agree with Lee on this, that there's going to be no chance of the rate rises going as far as they expect, because of the impact of declining private credit. But then on the sidelines, you will always have the fiscal policies now. If the unemployment rises, they'll be back in again with government spending.
Steve, is it also fair to say that the governments might be happy with inflation running a bit higher to inflate away the debt, the private debt?
Well, they don't know. They don't understand private debt. And this is what, if you talk about being, can I use the word pissed off here? Talk about being pissed off with this over time, because it's the private debt, stupid. This has been, pardon me, just turning around to get some more light here from my shaky cam. Private debt is what drives booms and busts. And have you seen the book called A Brief History of Doom?
No.
You haven't? Okay. The author's name is Richard Vague. Don't let the surname put you off. He's the most precise person I've ever known. And he made a fortune out of the collapse of Texas banks in the oil crisis of the 1980s. Because he took over a consumer division, privatized it, turned it into his own firm, did a similar thing with another one, then an energy company. And in the middle of all of it, he became aware of the dangers of private debt. He got the same sort of kookalas nonsense back from mainstream economists saying, don't worry about the assets, the debt, look at the assets. That was said to him by, I think it was Barclays Bank. So therefore, he sold his company to Barclays in 2005. And of course, the company crashed in 2007. With Richard's money out of it. So he went through looking at, he's now become a campaigner against the dangers of private debt. And he had a research staff that he had look at all the financial crises across the planet over the last 1.5 centuries. There were roughly 150 of them. Every last one of them was a private debt crisis. Every last one. And the biggest ones, the ones we all remember, the Great Depression, the Great Recession, even our 1990s recession we had to have, they all involve negative credit. Now, you can't get this through the neoclassical ears of the economists who run central banks. Some of them understand, there's a minority now who do, but most of them are still running their stupid dynamic stochastic general equilibrium models that don't even include money in them, and certainly don't include credit, and therefore don't see this coming.
And in terms of, obviously we're looking at relatively high debt levels in Australia.
Yeah.
Second highest in the world.
Second highest in the world.
Well,
that's right.
After Switzerland, which when you check their data, the gnomes of Zurich did not go. Yeah, exactly. And also a lot of that private debt is rich individuals using private assets for business ventures. So it's not tied up with the housing market in the way that is the rest of the world. So in terms of a debt market driven by the housing, we have by far the highest level of the world, and second highest in history compared with Denmark being the only one who ever had a high level of household debt, specifically directed at house prices.
And where would you see, like, if so we're at the extreme end of it in Australia, where would you see, I guess, the US and Europe sort of sitting relative to there?
Well, they're much lower than us. I mean, the level of household debt in Australia, I've got a chart which actually happens to tell me that. So Australia is currently, it did peak at 124% of GDP.
119.
It's now down to about 118% of GDP. Then you have Canada, which is one of the high debt ones. They're at 105. And then we go down the list, and when you find the United States, it's at 78%. So we're carrying about, yeah.
Where did the US peak in the 2006, 7?
No
Pretty
idea,
much
though.
100% of GDP. They peaked at 100%.
And just to, can I just add, like Ireland peaked at 117. So in 2008 or 2007. So we're above that.
We're in uncharted territory in terms of private debt loads. But the danger, the reason that we continue going back there again really is the government is dedicated to higher house prices. If you want to forget what they say they have as policy, you want to see what their policies actually are. It's to maintain high house prices.
Absolutely. And I mean, I'm going to give you a bit of a chance to do your I guess the political political pitch at the end.
Pitch, that's fine. Pitch is a good word.
Pitch is better. Yeah, that's right. But I guess if let's say you guys don't actually make it into power, and it is either Liberal or Labor, is there any real change? It seems to me at the moment all their any housing policies is a bit sort of rearranging deck chairs as opposed to
absolutely. No, painting the deck chairs. Yeah.
Painting the deck
chairs.
Right.
They're blue or they're red. Okay, that's very important. Okay, blue or red deck chairs. So when we start getting red deck chairs, I'll be arranging them precisely the same way, which is boost demand. Give more money to first-home buyers. Don't touch anything which encourages investment borrowing as well. And lo and behold, with another first-home buyers grant, and of course, Rudd doubled and trebled it during the global financial crisis. So that's what's one of the major factors that kept Australia out of the recession, was restarting the housing bubble. So I'm sure if Albanese gets in, and we can't pressure him, and we can't, there's no way they'll do what we're talking about. You're quite right. So it will be the same old, same old.
But for all these reasons, that's also why the RBA is not going to raise interest rates by 2+%, because they just simply can't.
That's right.
I mean, I'm a lot like you, Steve. I've been tipping under 100 basis points rise, and probably not towards the end of the year. Simply because and there's another elephant in the room here. We've got $500 billion worth of fixed rate mortgages that were originated below 2.5%, which are due to expire over the next 2 years. And this is a bit like the American situation when you had those teaser rates and then they adjusted. Australia's facing the same kind of thing, in that these fixed rate borrowers are going to have to refinance at probably double the rate if we got those sorts of rate rises. By starting from mid next year all the way through to mid 2024. So I just don't think the system can take it. Basically,
no, it can't.
Which is why the RBA won't do it.
That's right. We've borrowed ourselves into a corner. And actually, I did a chart ages ago, back when I was heavily focused on Australian housing, which was a set of parabolas relating the level of debt on the horizontal axis to the rate of interest on the vertical axis, and saying any combination of interest rate or debt gives you the same interest repaying burden. And what we're having, of course, the interest rates falling, we're pushing further and further along the x-axis towards the corner where you can't raise rates, because if you do, you go into recession if you pass over one of these parabolas. And it tended to be about anything close to an 8% of GDP interest rate burden on mortgages was enough to tip the economy into recession. And that's, we're getting down to the level where that will take a 3% mortgage rate, rather where you go the other extreme back in the 50s, it would have taken a 20% interest rate to give you the same impact.
Yeah. So, can I throw you a scenario as well? So let's say that the election occurs, the voters sort of abandon both the major parties pretty much. Labor gets more votes than the Liberals, but they're actually dependent upon a whole bunch of minor parties and a lot of the independents that sort of say that have I guess they're pitching themselves notionally as being economically pretty similar to the Liberals, but they believe in climate change and maybe some social justice. Do you think if that was the case, and the New Liberals were one of those sort of holding the balance of power in that case, do you think there is enough? It would be enough to get any housing changes done, or would the Titanic's just going to keep sailing in the same direction? And
well, you made an important point that a lot of those Liberals, the independents, are likely to vote the fiscal conservatives. Okay, we're not. Okay, we are the fiscal realists and say governments create money and that's what they should be doing. But they should be doing for the right purposes. And increasing house prices is not one of those right purposes. But that will put us completely on we'll be outside Parliament even if we're inside in terms of political spectrum compared with the other bargainers. So I think that will mean basically the same as you're saying before, and they'll be stuck. We'll have a continuation of the same policies which talk about supply, but don't do anything about it because supply is not. Supply is a state issue. I think actually we'd have to excuse even Morrison for saying that. Okay, so it's the sort of thing you can but hit your chest about and say we've got to do something about supply, and thank Christ that's somebody else's problem. And in the meantime, let's add to demand by another first home buyers grant.
Yep, that's right. And let's put our sign out to let anyone who is a supplier know that this is where to give donations if you need some help.
No, we'd never do that. Never. And that's one reason, by the way, we are if we do have any chance to box by the one thing that is going to potentially unite those independents, and certainly the New Liberals will lead it, short of blocking supply, and frankly, if I get in there, I'd be very tempted. Short of blocking supply, we want a federal ICAC with teeth, with retrospective powers as well, to go back over what's happened, certainly over the last 6-9 years. And I think that's a possibility, and that could, with that happened, I don't think Parliament will be doing much else if we manage to get a retrospective ICAC with teeth in there.
Yeah, well, and that hopefully that might uncover a number of things that might help the housing market as well. But actually, let's move back to the goods and services. Sorry, the inflation part, because I was leading somewhere with that, and I got sidetracked. So I guess the question. No, that was all right. The answer was good. So the question I had on that is, so the coronavirus hits, services spending drops dramatically, manufacturing jumps, which is part of the problem with the supply chains, obviously. But also, if I sort of look at there's the goods, there's services, and there's also housing expenditure by, and so after we got through the initial shock, lots more people want houses, people want to move out of apartments. I feel as if there's a lot of okay, I'm living with 4 other flatmates. I prefer to live with 3 other flatmates, or living with 3 other flatmates. I prefer to be 2, whatever it is. People need more space. I need an office from home. So, if there's there's certainly this idea that there's a structural change in demand for houses as well that's sort of going on. And I guess your thoughts on, I mean, obviously it seems to me that longer term, if people can work from home more and live further away from CBDs and in regional areas, that will help dampen house prices in the longer term. But in the shorter term, it doesn't. So I'd be interested in your thoughts around structural changes.
Yeah, look, I think you're quite right on that front, because the coronavirus was a huge hit to the pattern of demand, and that meant that we, as well as relying upon continuous supply of goods along the supply chain, you rely upon fairly stable demand as well, and that demand for services obviously has crashed. That's not applied by globalization, obviously, but demand for assets has risen dramatically. That's hit us with the price dynamics. That's a global phenomenon. I'm going to be selling into a house bubble in Amsterdam, so for once I'll be exploiting a house price bubble over here. So yeah, it's a global phenomenon, and the pressure on manufacturing as well, with of course the coronavirus is increasing demand at one side, but destroying supply at the other, because you can't produce the same output when half your workforce is off with a recurring disease. And so it's basically we're in a mess.
And if there's a trade-off, we're stuck in this trade-off: high inflation, interest rates rising. Consumers have this choice between spending. I guess they've been spending on goods, but they can't get the goods they want because it's the supply chain issues. Services are starting to pick up again, but sort of where they are. I guess which is and then housing. I guess I'm just asking for your gut feel here as to which is the are they all going to get hit at once if people's spending power comes down, or do you think maybe goods might be hit more, or services hit more, or housing expenditure hit more?
Well, services I think are the first ones to go, because you just don't want to take a service, because personal contact with somebody, whether it's a hairdresser at one extreme or massage at the other, that's increasing your danger of picking up the disease. And even our sovereign citizens have got a slight worry about that. So services are going to be heavily hit. Manufacturing, partially to some degree, if you can't actually even get the goods, then where do you put your money? And we end up being back in house prices again.
Yeah, so that's sort of it's that it's the construction side then. And Leith, I don't know if you obviously follow the construction stats pretty closely in terms of Australia.
Yeah,
US stuff starting to turn down a bit, but
yeah, look, it's we've probably got another 12 months of strong construction rates, just the hangover from home builder, because we got a hell of a lot of dwellings approved. A lot of them have been built now, and then after, so the next 12 months, once that big pipeline exhausts, all the future approvals data is showing that we're going to have a pretty big decline, I'd say, in housing construction next year. But it's just because the builders are super busy right now because they got the hangover from home builder. So there's a hell of a lot of people entered into contracts. A lot of homes are improved, and those are now. And it takes 12 to 18 months to build them. So right now it's all good, but from sort of next year onwards, once that pipeline's exhausted, it's going to be. I think the construction industry is going to hit an air pocket. Just as immigration's rebooted, so expect more, talks of housing shortages and all that sort of stuff.
And I guess that comes back to the we've spoken, Leith, in the past about the whole opening the borders to as many people as possible, and I noticed that the latest numbers are showing that hasn't really been coming back, and people have a reluctant. I guess to me there's probably partly a timing issue of Omicron obviously hit just as economies were opening back up again, and Australia was sort of saying yes, everyone can come back to Australia. I'd be interested to see whether Steve, I don't know if you've seen those stats. I think it was sort of net 2,000, was it?
Yeah. So basically, the federal government opened up the borders in November. They said they want 200,000 people by July, migrant workers by July, to try and bring down wages.
Yeah.
And we effectively had November was okay. December we got a pretty big jump, about 25,000 people, and then we got 2,000 in January. So it's come back down, and they just don't seem to be getting the numbers that the government's been wanting. But the data only goes to January, so it's who knows? It could be Omicron. It could also be that Australians, when they opened up, maybe had a whole bunch of people leave as well, which offset the incomings. But certainly this plan of having 200,000 people in 8 months looks to be in jeopardy.
Yeah, that again is assuming normality, and that's the normality we're assuming died in 2020.
Yeah.
And because I guess this was always my contention was that, look, I think a lot of people like to move countries when they feel secure about it, or they think there's lots of employment over there, and I think that the virus has sort of certainly shown that you want safety nets and you want other people you can rely on, and just in case strange things happen. And so I guess what I'm wondering is whether we'll see as much immigration just from people wanting to move as what
not anymore. I think that the days of wanting to move are gone in that sense, unless you're trying to get away from the worst effects of climate change, or political disasters like the Ukraine. But you don't come out of Ukraine with a house deposit.
Yeah, that's right. Now, I mean, that sort of moves sort of nicely into the idea of Ukraine, and certainly I wanted to talk energy prices. So you've got a lot talking on climate change on your site as well. I guess I've been sort of mulling over this idea that, look, the one silver lining to come out of this dark cloud out of the Ukraine is effectively Putin's given us a global carbon tax of 10% or so, or probably bigger on oil, and plus on European gas. I think it's probably certainly focused the mind on European politicians about how can you switch off Russian gas as fast as you can. Be interested in your thoughts. Is this relative to where we were before they attacked? Do you think this will be a speeding up of the move to more renewables, or do you think it'll actually just be other sort of transition fuels that will sort of try and take the lead?
Well, actually, Elon Musk actually made the point we need to increase oil and gas output in a hurry right now, given the current circumstances, and he's correct on that. But ultimately, yeah, people are saying, "Holy hell, we can't be dependent upon energy supplies that we don't control." Again, this is onshoring once more. And if you're relying upon Russian oil and Russian gas, that looks pretty silly. With NATO's, I'm going to blame NATO here. And the Americans behind NATO, pushing NATO's expansion to the stage where Russia finally overreacted drastically. But that, this is a bit like Australia's sending warships to China. Great idea when that's your main supplier of manufactured goods. Even worse for the Europeans, because that's their main supply of energy. So now the Europeans are obviously, and once it gets settled in the European bureaucratic mind, it doesn't go away. So it's not going to be transitory. This will be a strong pressure for renewables. Maybe Germany will cease the plan to shut down its nuclear power plants. And we're going to see a huge push for producing as much energy as possible in Europe, rather than relying upon imports from Russia and Saudi Arabia.
Yeah. So, I mean, my rough figures say that, look, at gas prices where they are in Europe, yeah, absolutely. Solar power plus a battery, even in some of the poor countries with poorer sunlight, certainly adds up. If you have to pay, 30 euros or 40 euros for your gas per MMBTU, but the lower it goes down, obviously that the lesser that becomes an issue. But it would seem that there would be a psychological, we've hit a psychological point for governments there, that look, regardless of whether the economics are marginal or not, they're at least close enough that from a security perspective, it's worth doing.
Yeah, that's true. And I think that means we're going to see huge pressure on renewable inputs such as lithium, because we simply, we can't rely upon the manufacturing supply chain we built over the last 40 years. We don't have the minerals supply chain to enable that much of a ramping up in production of photovoltaics. And so I think we're seeing at that end, quite a few of my commodity speculation friends are in there buying stocks in lithium, even buying stocks in uranium, because they think there's just the supply pressures there are going to be enormous as well.
Yeah, well, look, and I mean, my take sort of because I get asked on lithium a lot, is that lithium seems to me a bit like iron ore. When you want to do it, you need a really big mine to make it cost effective. And so what it seems is, in the past, it's been prices prices rise, and then somebody builds one of these massive big mines, and then prices crash for a bit, and then you go through that cycle. And it seems as if we're in this phase now where obviously prices have run up very hard. There's a number of new mines being planned and developed, but they're going to take time. And so to me, that's one where you might like the long term perspective for it, but you just want to be careful that you're not
buying in when the mine is about to open.
Exactly. It's going to be volatile.
So actually, I recommend you take a look at the work of Simon Minsky. Have you heard the name at all?
No. How do you spell his surname? Sorry.
Michaux.
Yeah.
Despite the strange sounding name, he's a third generation Aussie from Sri Lanka and the Huguenots. He's currently working for the Geological Survey of Finland, and he's done a truly brilliant overview of minerals demand as we transition from a fossil fuel industry to what he calls a minerals-based industry. And to put it this way, it doesn't look good. We don't have the lithium we need for the scale of transition. So we better hope that rust-based batteries and things like that start becoming realistic technologically, because we need to be relying upon commodities which are abundant in the crust, not ones which are very marginal in the crust. And lithium fits in the marginal category.
What is it? Because the question on that fits the idea of the China housing as well. It just comes back to copper in terms of a lot of people are obviously pushing copper as saying it's great, it's going to be in huge demand for all these changes. EVs need a lot more of it. Our take's been saying, well, yeah, sure, that does, but transport's sort of quite a small proportion of copper's use, and if the Chinese housing market keeps falling, then there's actually a lot of copper that sort of frees up. I don't know whether that's maybe we're straying outside the core expertise here. Is that
spent a bit of time in China and
Yep.
had a relationship there with a woman who'd be one of the many who'd bought an apartment inside a high-rise building, and we went there in 9 high-rise towers with an unfinished garden, and there were 8 cars in the parking lot, and her place had bare concrete walls. The lift, you had to knock on the lift door for a woman who's operating it to come down and stop pressing her mobile phone to take you up to the floor level to see it. It looked a bit fragile to me back then, and I was wondering what the actual dynamics were behind it.
How long ago? Sorry,
that was 2014.
Right. Okay.
Wow.
Yeah.
Peak time. I've been back since then, and I've seen when you see the scale of the building, it is just stunning. The scale and but it's got a combination of factors behind it. But the local councils, I wonder where's the money coming from, because it's government created money behind a lot of it. But what was going on was developers would buy land on the periphery of a local government area. We're talking local governments with 4 million people in them, and that money was what provided the local government with the ability to do the overinvestment they were doing in manufacturing. So the whole thing was tied together. But the ghost cities, it's a very real phenomenon. And when it falls over, then you simply can't go back and restart it because you've got far too many buildings to begin with.
Yes, and I guess that's where we're coming from. Is look, there's a lot of copper goes into buildings, and if you if you didn't need to build as many, if you halve the level of building, say in China, then that'll supply enough copper to bring you through 5 or 10 years of EV development, because
those high rises could turn into copper mines.
Yeah, that's right. That's right. So, Leith, I don't know, have you got any more questions? I guess thoughts on the housing market. Otherwise, we might let Steve
look,
edit.
Look. I mean, for anyone who cares, my views, the housing market, is peaking. I guess peaking. No, it hasn't peaked, but it's getting close. And I think by mid-year we're going to have Sydney and Melbourne probably going to be going backwards, and if we get some interest rate rises towards the end of the year, well, next year is going to be pretty bad. So that's my 30-second thing. But I am interested though in I went through Steve's. Can we get on to the political stuff?
Yeah, sure.
Yeah. So Steve's running for the Senate, obviously, aren't you, for the New Liberals?
In New South Wales.
Sorry, Senate for New South Wales, yeah. And you've got a quite interesting proposal on your website around housing affordability to restrict credit, I guess, to a ratio of gross rents. So I think what you propose is initially 20 times, then reduce it to say 10 times over 10 years or something. So
that's right, yeah, that sort of thing.
Effectively, that'd mean if you got a 1,000, if the property you're buying has $1,000 a week rent, you could borrow about close to 1.1 million initially, and then after 10 years you can only borrow about 520,000. So 1.04 million, and then after 10 years that same price property you borrow about 520,000. Is that if I basically got that right?
You basically got it right. I mean, the other side of it is we know that would cause a crash in house prices, and we want to see house prices fall. We don't want to see household equity being wiped out, which is what happens when normally house prices fall. So we'd marry that with the idea of using the government's money creation capability to do what I call a monetary reset and reduce the amount of money we've created that's backed by household debt and change it being backed by government fiat instead. And in that case, what it means is a cash injection to people who have mortgage. Well, everybody gets the same cash injection. It's across the board monetary reset because we've let the banks run the roost for far too long. And they're saying you stop them running the roost, you have to try to maintain the equity they've inflated that people have out of their house prices. We're going to bring your debt down, but try also to bring the house prices down at the same time. And then the real causal factor, the thing that causes house prices to rise, is accelerating mortgage debt. And that's screamingly obvious in the data. It's a global phenomenon. We simply have to stop hitting the accelerator on mortgage lending every time there's an economic downturn, which has been the way governments have inflated the asset markets to cause an inflation in the real economy, and that's been government policy. It's absurd, and it's got us into this situation. We have to get out. So be getting out of it, and then say we don't fall back into it, you stop letting people lend enormous rates on, the expectation somebody's going to borrow more money than you did to buy the place off you. Control the level of household lending and gear it up to income, so we don't get these gigantic disparities we have today.
So it's effectively two steps. So first of all, you do the monetary reset, so everyone gets
Yeah.
credit from the bank, and then my understanding is, if you're lucky enough to own your own home outright, you get effectively a government bond which pays you a coupon. Is that right?
Effectively, yeah. And we're still going to fine tune that. We hope to restore realistic interest rates, but you can't have realistic interest rates unless you have realistic levels of private debt, and that means about 1/5 the level of household debt we currently have. So rather than 120%, about 25% to GDP, and that's the ratio we had back in the 60s, early 60s and 70s.
Pretty
So get back
to
to that
Ireland's
level.
at now, actually. Ireland's come down to about that.
Yeah, I know. Ireland's a crazy set of data. People haven't seen it. Ireland basically built the pyramid of Giza in terms of its ratio of household debt to GDP, up like a rocket and down like a running down a pyramid on the other side. So yeah, we want to get there without the economic crash that caused in Ireland, and that's what the monetary reset would do: prevent the collapse in house prices, causing a collapse in household equity, and therefore causing an enormous economic and social crisis.
I've got a few more questions actually in from watchers.
Yeah.
So some questions. So let's see. Let's have a look for.
I've got one just here, Damien.
Go.
So one of the viewers is just curious on everybody's thoughts on the housing market's impact on millennials and the national fertility rate, and when the government might need to intervene. And what they mean by that is in terms of childcare measures or maybe baby bonuses.
Who wants to go first?
Pass that to Steve. He's the politician here.
I'm no fan of Big Australia. Okay, I think we again, sustainability rather than specialisation and growth has to be the theme for the next 20 or 30 years of human civilization. And the level of population we already have globally, I think, is beyond sustainable. The idea that Australia should be trying to have a big Australia, I think, is just wrong. So I think we've just got to get away from relying upon population growth and start looking at technological development and industrialization and investment as the basis of economic growth, if we have it, rather than the focus being get as many bums on planes as flying into Australia and boost the economy by boosting how many people there are in it.
So basically what you're saying is what I've been saying for years: more Denmark and Norway, less.
I was part of
Australia. Less Australia.
I helped draft the accord before it got turned into a wage restraint document, and as part of that drafting, we were trying to build a Swedish Nordic approach to industrial development policy in Australia. And the bureaucrats, particularly the economists, of course, in the government, just wanted GDP growth the old-fashioned way, trade specialisation, houses and holes, as you guys put it so well. Specialise in raw materials, don't manufacture anything locally, and growth. Large part of the growth is simply population growth, and that gives us. We've got a very dumb capital stock. When you look at sort of Australia's industrial sophistication using what's called the Atlas of Economic Complexity, I'm sure you guys are aware of from Harvard University, we used to rate 55 in the world. That was pretty bad. We now rate 86.
Yeah, right.
Cambodia,
Uganda, I think. Yeah.
Well, Cambodia used to rate 123. It's now one of our neighbours. Okay, it's 88. We're 86. So in terms of complexity of the industrial structure of the country, we're at the level of third world countries we used to send aid to. And on that note, of course, I noticed that Singapore sent Australia aid for the floods in the Northern Rivers recently. We've got to reindustrialise, not reborn. Pardon shaky cam here with my back.
That's right.
Can I just say in response to their question, basically, the millennial housing situation sucks. But I don't think it's going to change because, and I don't think the government's going to do baby bonuses and stuff. As Steve said, they'll just pull the migration lever. They'll try and offset the declining birth rate by just bringing people in, and that'll be the solution rather than trying to do it internally and trying to create a better system internally. They'll just try and go the easy route, pluck people from offshore, and that'll
Yeah.
that'll plug the hole in the short term. It'll make also housing worse.
But both of those as well is like is ignoring, as I said, the elephant in the room, is saying, okay, we've got this problem where whether it's school fees going up and house prices going up to the stage where people are like, oh, I can't have as many babies as I want, so let me just have fewer so that I can actually afford it. It's actually saying, and then you're going to go stick a band-aid over that by bringing more people in to, it's like, well, why don't you go back to the root source and just, if you bring house prices down, then people can have as many babies as they feel like
exactly.
they want. You don't worry
Exactly.
about all these other factors or giving baby bonuses to account for the fact that we've got too high house prices. So here's a bit of here's
I know.
a short-term fix. Yeah.
There's actually a wonderful cartoon from Patrick Cook some decades ago, a bit like an Ozymandias cartoon, and it had apparent interest rates fell and everything else followed. Well, the thing which we've been trying to rectify in this country is house prices. Forget about the level of technological development, forget about the climate. Look how good our house prices are. That's no way to run a country.
No, and we want our innovators and our people who have the get up and go to go. Yeah, let me go and start a new company to build something. Not let me go and buy a few houses, do them up, and see if I can flip them to somebody.
Before you can actually start doing the industrialization, and then you become a property speculator. Yeah,
exactly. Yes. Questions? There's a few more questions there, Sam.
Yeah, so there's a question here about the thoughts on US-style mortgage bonds so that the RBA can raise rates without affecting repayments on existing loans.
So I guess it must be longer term. I'm guessing they're asking about longer term loans rather than everyone being on variable rate mortgages and 3 year. Is it you end up with 30 year?
Oh, is it so? I think the reader is saying, can we get 30-year fixed mortgages like they have in the US?
Great. Let's go for 99-year mortgages like they have in Japan. Why be modest? Let's outdo the Japanese 150-year mortgages. That'd be a good idea.
It's a pass one. Well, we've spoken about that in the past. As I said, like you're a renter at that stage. You're just renting from the bank rather than
that's what we are. I mean, that's actually I really recommend people to take a look at the affordable housing policy I've got on my website, Keen for the Senate. Not so much for terms of vote for me, though of course I want that. But take a look at the first chart, and that shows the level of household ownership by sector, by whether you own the house outright or whether you are mortgage or you're renting. And of course, we all know the aim of government policy has always been to increase house ownership. Well, the people who own houses outright, pardon me doing a bit of webcam swing here, have gone from 43% of the population in 1989 to 32% in 2018. Those people own their house outright. From 40% of the population to 30%. Those who have a mortgage from 30% to 38%. Those who rent from 16% to 26%. So what an outstanding success the policy has been. We've had a decline in home ownership, increase in indebtedness, and increase in the percentage renting out of a policy supposed to increase household security. So, this is the classic, so-called Einstein quote. Doing the same thing every time and expecting a different result is the definition of insanity. So let's stop pushing up house prices.
So actually, well, having said that, I guess the question on the on those mortgages, the US is pretty unique in terms of having those 30-year mortgages, is my understanding, and it's a sort of market structure that it would be very difficult to replicate anyway, though, isn't it?
So, yeah.
Like elsewhere we're looking at right throughout Europe, it's closer to ours than what it is the US, is my understanding.
And one of the reasons people go for us not having a crisis back in 2008 was the absence of those long-term fixed rate mortgages. But equally, of course, with the variable rate, the impact of house interest rates going up is much, much faster here than it is in the States. So, I think what we're seeing is the policymakers have got themselves up a certain creek without a paddle, and now they're trying to use their hands.
Right.
Okay, guys. So we're just
a fantastic note to finish.
Yeah.
I thought I timed it well.
We must have something better than that for you to. What other plugs have you got? That's right. What other plugs have you got for your for I guess policies that you're looking in?
Well, the main thing is we're probably the world's first anti-neoliberal economic policy party. Okay. People get, when they see liberal in the name, think, oh, it's just a carbon copy of the Liberal Party. Anything but. The Liberal parties have stolen the word liberal from its 19th century meaning. So that's the reason the founders of the party chose originally the New Liberals as the party name. Now it has to be TNL, as Lee pointed out on the ballot papers, because of a law change directed specifically at our party. But we are anti-neoliberal economics. Okay, and that applies to the attitude to how government spending should be done. It applies to the whole focus on driving up house prices. It applies to offshoring rather than bringing manufacturing back onshore. And it's also part of the big Australia thing, rather than trying to have a population that's relevant to the geographic capacity of the country. So if you want anti-neoliberal policies, we're your party. If you want neoliberal parties, you can go vote for the other mobs, and it could be either Liberal or Labor in terms of neoliberalism per se. But we want to change the argument, because we've been doing this for 40 years, and this is part of why we're seeing a global sense of impasse, because there's no further to go on any of those policies, and we shouldn't have gone that direction in the first place.
Excellent. Sam, back to you, I think.
Okay, so now we have our viewer question of the week. So this is for some of the viewers to have some discussion in the comments over the coming days. So you might have guessed the question already, but for this week, it's, has the Australian housing market peaked? So feel free to post your thoughts and engage with us and some of the other viewers over the coming days. So that almost wraps us up. So Damien, I just want to thank you for sharing your knowledge as always.
Thanks, Sam.
And Leith, thanks for your unconventional economist insights.
Thanks. No worries.
And Steve, thanks for joining us and sharing your perspective. And we just want to wish you all the best for the upcoming election.
Thank you. Vote for the TNL everywhere, and especially in the Senate in New South Wales. If anybody's going to stir up the Senate, hopefully it's going to be me.
Excellent. Well, good luck with that. And we do welcome your feedback on the show, especially in regards to suggestions for future topics. If you do have any ideas, please drop it in the YouTube comments below, or send us an email at contact@nucleuswealth.com. Just a reminder, this is general advice and does not take into account your personal situation. If you do want to discuss your personal financial situation, please go to our website at nucleuswealth.com and book a call with me or one of the team. So with the recent events unfolding in Ukraine and Russia, this has made many investors reevaluate how their funds are invested, and many have decided they don't want to be investing in countries like Russia. So Nucleus Wealth has around 50 different ethical sector and asset class screens that allow you to customize your portfolio based on your values and beliefs. You can have a look at these on our website here at nucleuswealth.com/ethical. These screens can be utilized across all our passive and active portfolios, so you can truly tailor your portfolio to your individual preferences. An example of this is our human rights category. So you can screen out undemocratic countries, economically or morally repressed countries, and a range of other human rights screens that you can see there. And we also, in our war category, you can also screen out the worst offenders, which is landmines and cluster munitions, or everything to do with war. And you also have the option to screen out nuclear weapons also. So we've written several different articles about these recently, so feel free to have a read, and you can find these under the resources tab on our homepage, or sign up to our newsletter to receive all our content in your inbox. So don't forget to like the video now. And finally, if you know of anyone that might get some value out of today's episode, we'd appreciate it if you can please share it with them. Also, if you'd like to see more of our previous episodes and content, head over to nucleuswealth.com/content. And to stay up to date with news from us, you can also follow us on all major social media. So for myself, Damien, Leith, Steve, and the rest of the team at Nucleus Wealth, thanks for watching, and we look forward to seeing you next time. Bye for now.